Good afternoon, folks, and welcome to yet another quick video from the Ticker Guy. This is Carl down in sunny Florida, and today it is sunny. Listen, I want to talk to you about something that's very serious today, and that is the potential intentional engineering of a bond market collapse by none other than our Fed chairman. Folks, this is conjecture. I can't prove it, but I want you to go back very carefully, listen to the C-SPAN exchange between Ben Bernanke and Senator Kennedy during the time that he was on the Hill last week. I want you to pay careful attention to that testimony and that exchange, and I want you to think of it in these terms. Remember, folks, Ben Bernanke is a banker. The central bank is the Federal Reserve is a central bank. It is a private institution. It is federal, kind of like Federal Express is. It runs under charter from the federal government with the explicit blessing of Congress and under explicit enabling law, Federal Reserve Act of 1913. You remember that Ben Bernanke is a student of the Depression, and one of the things that he claims caused the Depression was the inappropriate tightening of monetary policy by the Federal Reserve. But in point of fact, the Federal Reserve doesn't set interest rates. It follows the market and always has. You can see this. It's proven. Go take a look at the IRX, chart of the IRX, folks, in whatever charting software you use in the market. It's the 13-week T-bill and the Fed funds target. And you will see very clearly that the Fed follows the short-term credit market, not the other way around. So what caused bond market rates to spike? What made credit get tighter during the Depression years? What made that happen in 1931? Very simple. Congress attempted to backstop the losses that had been taken from speculation both in real estate and in other markets. As they took that debt onto the public balance sheet, the bond market reacted violently and sold off. Bernanke blames the Fed for inappropriate actions, but in fact the Fed had nothing to do with it. Congress was responsible for this, not the Federal Reserve. Now, go listen to that testimony and that exchange between Mr. Bernanke and Senator Kennedy. Realize one thing, folks. Senator Kennedy, whether you love him or hate him, is arguably the most powerful individual, powerful single person on Capitol Hill. What he wants, he usually gets. The exchange went something like this. Well, we have this thing with Bear Stearns, and we're wondering what you think, this is Senator Kennedy, we're wondering what you think we should do for the broader economy. Bernanke, well, that's your decision. That's outside my realm. Well, we're not asking you to tell us what to legislate. We're asking you what you think we should do. Well, that's beyond my purview. That's your decision. Well, damn it, what do you think we should do? And, he got louder with every line. And Bernanke kept coming back saying the same thing. Well, that's your decision. That's not my decision. It's your call. All right. Now, let's say for the sake of argument that you are well aware that the federal government has a $9 trillion public debt. You also know that if the bond market is provoked into a violent sell-off, a vicious collapse, that the result will be a spike in borrowing costs for everybody within the economy. Your banker buddies will make a lot of money if that happens, and furthermore, a lot more loans will default, and the banks will end up with the assets. Bernanke also said in his written papers on the Depression that the Fed can always stop a deflation because it has a technology called the electronic printing press. But what Ben has been actually doing and what he says are two different things. He's been selling off much of his stock of treasuries into the open market, removing dollars. Inflationary, using the printing press to prop up the currency in an inflationary attempt. I would argue that he's doing the exact opposite. You can believe what you want, folks, but you need to be on your guard against this. This is up to Congress. We need to stop this within Congress. This is not the Federal Reserve's doing. Ben Bernanke's $30 billion backstop may have been a masterful stroke. Senators went home during their break over Easter, and they were told repeatedly by constituents, "Where's mine?" Now we got it from the home builders. They want big tax breaks in the form of lost carrybacks. We have individual homeowners screaming for foreclosure relief. We have every segment of society trying to get their hands in the larder. We have a bill right now up in the Senate that is being porked up as we speak. Senator Dodd is the one who is more or less putatively in charge of this. Folks, you need to understand something very clearly. If we take this debt onto our balance sheet and we precipitate a bond market collapse, we will get a rerun of the 1930s. This is not a maybe. This will happen. It is up to us. We need to get on the phone and we need to tell Congress this cannot be allowed to occur. We cannot change it once the bond market collapse happens. If we provoke one, it will be too late. The ticker that is up and is linked to this posting in the presentations area on tickerforum.org has the market ticker for today, which is called Who Are They Trying to Fool? About half of that ticker entry bears directly on this. And folks, I'm telling you, this is my opinion. I cannot prove any of it. But what I can tell you is the parallels are striking and frightening between what happened after the stock market collapse in 29 and what is happening here. We haven't seen a stock market collapse, but what we have seen is a tremendous speculative credit bubble, just as we did in the 1920s. And the playbook, in order to force a deflationary credit collapse, is being run piece by piece in almost exactly the same form that it was run in 1930 and 31. If we allow this to occur, it will be unstoppable, and we will unwind all the way back until all of that debt is unwound and defaulted. And those of you that are in debt, your assets will be owned by those bankers. Your option to do something about this will expire when the bond market takes notice of what's going on. I don't know when that will happen. I don't know if it will happen. All I know is that if it does, there won't be any opportunity to do anything about it at that point in time. So we either act now, or we cede to the possibility that this is exactly what they intend, and we take whatever consequences come from it. Have a good day.